Hello everyone, welcome to the 123rd episode of me learning how to trade in Forex. So in the last episode we went through be careful, currency correlations change. So we went through the table and it shows that as the time period is different, as the time periods changes, then sometimes the two currencies correlation also changes results. And it could change from anything like positive to negative, or negative to positive, or even to random at points. So that's that. Currency correlations change for many different reasons as well. So include anything from a country changing its interest rates, to shifting monetary policies, or any collection of economic or political events reshaping the trader's sentiment on a currency. So now we're on to how to calculate currency correlations with Excel. So let me just move that out. To calculate currency correlations with Excel. Date is a second. As you've read, correlations will shift and change over time, so keeping on top of current coefficient strengths and direction becomes even more important. So correlations change and shift over time. Lucky for you, currency correlations can be calculated in the comfort of your own home, just you and your most favorite spreadsheet application. For our explanation, we're using Microsoft Excel, but any software that utilizes a correlation formula will work. Step 1, we're assuming that you won't be magically creating the daily price data out of thin air, but rather we'll be getting it from somewhere online. One source is from the Federal Reserve. Step 2, open Excel. Step 3, copy and paste your data into an empty spreadsheet or open the exported data file from Step 1. Get the last 6 months. Jesus, this is a really old Excel layout format. But anyways, it's got the dates, Euro USD close, USD JPY close, USD CHF close, GBP USD close. 2009. Step 4. Now arrange your data to look like the following or something similar. Colors and fonts are up to you. Have fun with this. Yellow might not be the best option though. Yeah, yellow really isn't the best option. The date here, Euro USD close, USD JPY close, USD CHF close, GBP USD close, and this is arranged in from the highest to the lowest, I think. So in descending order. Step 5, it's time to decide on the time frame. Do you want last week's currency correlation, last month, last year? The amount of price data you have will dictate this, but you can always get more data. For this example, we're using the last month. So yeah, okay. Step 6, in the first empty cell below. In the first empty cell below your first comparison pair, I'm correlating Euro USD to the other pairs, so I'm starting with the Euro USD and USD JPY. Type equals correl open bracket. Next, select the range of cells for the Euro USD's price data, followed by a comma. You'll be surrounding this range with a box. So from B112 to B132, B112, so from here to here. After the comma, select USD JPY's price data range, just like we did for Euro USD. So C112, that's here, to C132, that's here. Click enter the key on your keyboard to calculate the correlation coefficient for Euro USD and USD JPY. So we've got a correlation coefficient of 0.63 basically. Repeat steps 5 to 9 for the other pairs and the other time frames, and for other time frames. When you're done, you can take your new data and create a cool looking table just like this. Man, that's pro status. Euro USD close, 1 week, 1 month, 3 months, 6 months, and then the correlation coefficients. For 1 week, 1 month, 3 months, 6 month, and 1 year trailing periods provide the most complete view of the correlations between currency pairs. So the 1 week, 1 month, 3 month, 6 month, and 1 year trailing periods provide the most complete view of the correlations between currency pairs. But it's up to you to decide which or how many time periods you want to wish to analyze. While it might be overkill to update your numbers every single day, unless you're a currency correlation addict, updating them at least every other week should be enough. If you find yourself manually updating your currency correlation tables every hour on Excel, you might need to get out and pick a hobby. Get out more, pick a hobby. Every other week, at least every other week should be enough. So updating them every week should be enough. The correlation calculations should be updated every week. Okay, summary, currency correlations. So 02, 05. Like synchronized swimmers, some currency pairs move in tandem with each other. And like magnets of the same poles that touch, other currency pairs move in the opposite directions. When you are simultaneously trading multiple currency pairs in your trading account, the most important thing is to make sure that you're aware of your risk exposure. You might believe that you're spreading or diversifying your risk by trading different pairs, but you should know that many of them tend to move in the same direction. So when simultaneously trading multiple currency pairs, ensure you're aware of your risk exposure. By trading pairs that are highly correlated, you are just magnifying your risk. Correlations between pairs can be strong or weak and last for weeks, months, or even years, but always know that they can change on a dime. Trading pairs that are highly correlated, you are just magnifying your risk. Trading highly correlated pairs can magnify your risk. Correlations can change at any time. Can and will change at any time. Staying up to date with the currency correlations can help you make better decisions if you want to leverage, hedge, or diversify your trades. A few things to remember. Coefficients are calculated using daily closing prices. So correlation coefficients are calculated using daily closing prices. Positive coefficients indicate that two currency pairs are positively correlated, meaning they generally move in the same direction. Positive coefficient means the currency pairs are positively correlated, so they move in the same direction. Negative coefficient efficient means the currency pairs are negatively correlated, so they move in the opposite direction. Negative coefficients indicate that two currency pairs are negatively correlated, meaning they generally move in the opposite directions. Correlation coefficient values near or at +1 or -1 mean the two currency pairs are highly correlated. Yep, so correlation coefficients show strength and direction of the trend of correlation. So zero correlation means there's no correlation or random correlation. +1 strong positive, -1 strong negative, and then yeah. Correlations can be used to hedge, diversify, leverage up positions, and keep you out of positions that might cancel each other out. So correlations can be used to hedge, diversify, leverage up positions, and keep you out of positions that might cancel each other out. Currency pairs that typically move in the same direction: Euro USD and GBP USD, Euro USD and AUD USD, Euro USD and NZD USD, USD CHF and USD JPY, AUD USD and NZD USD. Currency pairs that typically move in the opposite direction: Euro USD and USD CHF, GBP USD and USD JPY, USD CAD and AUD USD, USD JPY and AUD USD, GBP USD and USD CHF. When you find yourself wanting to trade two pairs that are highly correlated, it's okay if you take both setups. Just make sure you have rules in place when you traded correlated pairs, and always stick to your risk management rules. Okay. Quiz. Bonnie and Clyde, peanut butter and jelly, Justin Bieber and his hair. Some things just go well together, just like currency correlations. How well do you know these? What is a Forex term used to tell us the relative direction of movement between the two currency pairs over some period of time? Currency correlation. Currency correlation tells us whether two currency pairs move in the same, opposite or totally random direction over some period of time. When two currency pairs move in the same direction, they are said to be positively correlated. A positive correlation implies that the two currency pairs will move in the same direction. When the correlation between the two currency pairs is equal to 0, they are not correlated. If the correlation is 0, the movements between the two currency pairs is said to have 0 or no correlation. They are completely independent and random from each other. True or false? If the correlation between two currency pairs is equal to 2, then their correlation is stronger than two other currency. Wait, what? 2. False, because a correlation larger than 1 is not possible. Correlation is computed into what is known as correlation coefficient, which ranges between -1 and +1. If you buy AUD USD and you want to hedge your risk, which currency pair is the best option out of the following 3? You want to hedge your risk, so you want something that does the opposite of AUD USD. Because if you buy this and then AUD USD goes down, you would want something that when you buy it, it goes up, because then that profit hopefully hedges some of the risk of buying AUD USD. So what's the opposite of AUD USD? USD CAD, USD JPY. That one. If you buy AUD USD and you want to hedge your risk, USD CAD is a currency pair that you can buy. If you take same direction trades on two pairs that are positively correlated, your risk potentially same direction increases. Taking the same direction trades on two pairs that are positively correlated is the same as doubling up on a position. In other words, you are increasing your risk. Which of the following is not a benefit of learning about currency correlations? Risk is eliminated. Learning about currency correlations will not eliminate risks, but it can help you become a smarter trader and make more responsible risk management decisions. Which of the following aren't usually positively correlated? Oh, I don't remember this. Euro USD and USD CHF. GBP USD and USD JPY. USD CAD and AUD USD. USD JPY and AUD USD. No. GBP USD and USD CHF. Aren't positive usually. That's definitely positively correlated. AUD USD and ZD USD. USD CHF and Euro USD. USD CHF and Euro USD. This one, the first one. Euro USD and USD CHF have an almost perfect -1 inverse correlation. Which of the following are typically inversely correlated? GBP USD USD JPY. GBP USD and USD JPY are typically inversely moving pairs. True or false? The great thing about correlations is that they don't change. False. Correlations between pairs can be strong or weak and last for weeks, months or even years, but always know that they can change on dime. Nice. Okay. The 5 deadly O's of trading. What traders do to guarantee their own failure? Okay. The 5 deadly O's of trading. What traders do to guarantee their own failure? Did you know that the 5 deadliest factors that cause traders to fail are self-inflicted? Many traders self-sabotage their own trading and may not even be aware they're doing it. When a trading account goes to zero, they have nobody to blame but themselves. Trading account, kaboom, sign. While it might be too late for these traders, fortunately it's not too late for you. We want to make sure that you don't suffer from the same blind spots and can hopefully avoid sharing the same fate as a blown account. To make it easier to remember, we call these negative factors the O's of trading, and there are 5 of them. There's even a keto-friendly cereal inspired by the O's. Trading O cereal, loser. Okay. A lot of traders have eaten this metaphorical cereal, even vegan traders. While it looks delicious, you want to increase your chances of success as a trader. While it looks delicious, if you want to increase your chances of success as a trader, you should definitely avoid eating this as part of your trading diet. What are the 5 O's? 5 deadly O's of trading. Overconfidence, overtrading, over-leveraging, overexposure, overriding stop losses. So, let's take a look at each O more closely. Overconfidence. Overconfidence isn't simply the feeling that you can handle anything. Overconfidence is characterized by an inflated belief in one's own trading skills. inflated belief of one's own trading skills. Too easy. Confidence is critical in becoming a successful trader. When you're confident, you're more likely to take risks or look for opportunities. However, it's one thing to believe that your trades can potentially be profitable, but it's another thing to think that you know everything about the markets and there is no way for you to ever lose because all you do is win. You are not DJ Khaled. While confidence is necessary, too much confidence can have negative consequences. This phenomenon is known as the overconfidence effect. The overconfidence effect is a cognitive bias in which someone believes subjectively that his or her judgment is better than or more reliable than it objectively is. Overconfidence is a overconfidence effect is a cognitive bias in which someone believes subjectively that his or that their, we should call it that their judgment is better or more reliable than it objectively is. So they think that their judgment is better than or more reliable than it actually is. Basically, when your confidence is high, your opinion of yourself is higher than what an impartial or rational person who is not your mum would think about you given the same set of facts. Psychologists observe overconfidence in 3 distinct forms. Confidence is observed in 3 distinct forms. Overestimation, over-precision, over-placement. Overestimation is a tendency to overestimate one's performance. Overestimate one's performance. Over-precision is the excess confidence that one knows the truth. That one knows the truth. Overplacement is a judgment of your performance compared to another. Your performance compared to another. Said differently, overconfident folks believe that they're better than most and overestimate the precision of their knowledge and the level of their abilities. For example, if you ask a bunch of random people to rate their own driving abilities, you'll find that most people consider themselves to be above average drivers. If everyone is an above average driver, where are the average drivers? True. To minimize the effects of the overconfidence effect, you must take time to truly understand yourself and what you are capable of achieving. You must be aware of your limitations and what opportunities are not worth pursuing. Wait, so to minimize, it's not minimize, to minimize the effects of overconfidence, you must take time to truly that's also true, truly understand yourself and what you are capable of achieving. You must be aware of your limitations and what opportunities are not worth pursuing. You must be aware of your limitations and what opportunities are not worth pursuing. Most importantly, you must always consider the possibility that you are wrong. Always consider the possibility that you are wrong. To listen to new evidence and to know when to change your mind. That you are wrong and be able to listen to new evidence and to know when to change your mind. You must have the confidence to trade, but this must be balanced with intellectual humility. Here is some intellectual humility. Okay, that's overconfidence. Overtrading, including revenge trading. So includes revenge trading. Overtrading is when you're trading too frequently. When you trade too frequently, taking extreme large trades and or taking uncalculated risks. Successful traders are extremely patient. Quality setups take time to materialize, so they remain patient and wait for confirmation. Successful traders are extremely patient. Quality setups take time and to materialize, so they remain patient and wait for confirmation. It doesn't matter if the setup takes 2 hours or 2 weeks to take shape. What matters is protecting their capital, so they will wait until the odds are more in their favor before entering. You will know if you are overtrading. If you close a trade for a loss and deep down you feel like you shouldn't have taken the trade, then you're guilty of overtrading. They protect their capital by waiting until favorable conditions occur to enter. Before entering the trade. You will know if you're overtrading. If you close a trade for a loss and deep down you feel like you shouldn't have taken the trade, then you're guilty of overtrading. WTF was I thinking? You will know if you're overtrading. Know if you are overtrading. If you close a trade for a loss and deep down you feel like you shouldn't have taken the trade, then you're guilty of overtrading. If you close a trade for a loss and you feel like you shouldn't have taken the trade, then you're over trading. For example, when you're supposed to trade from a daily chart, do you find yourself still looking at the lower time frames like the 5-minute chart and discovering better trades there? Do you find yourself spending hours staring at charts and trying to force a trade with a good enough setup? Spending too much time staring at charts tends to cause overtrading because you become prone to falling into a trance looking at so much price action and indicators that magical setups will just start appearing, which are actually just mirages. Spending too much time tends to cause overtrading because you're prone to falling into trance looking at so much price action and indicators that magical setups will just start appearing, which are actually just mirages. Revenge trading. Letting your emotions get to you regarding your trading performance is dangerous. When it comes to trading, the head, not the heart, should be in charge. Don't use emotions when trading. Use your head, not your heart. Trade with this, your brain, not with this, your heart. When you suffer a large loss or a series of losses within a short span of time, you might be tempted to revenge trade. You want to get back at the market. Revenge trading is when you jump back into a new trade right after taking a loss because you believe that you can quickly flip the loss back into a profit. Revenge trading. When you suffer a large loss, a short time, you might be tempted. Revenge trading is when you jump back into a new trade right after a loss because you believe you can quickly flip the loss back into a profit. This new trade will quickly recover the loss I just made. When you start thinking like this, your state of mind is not objective anymore. You become more prone to making even more trading mistakes, which results you in losing even more money. How do you avoid revenge trading? When this happens, your state of mind is not objective anymore. How do you avoid revenge trading? Be fully present and fully focused while trading. Make sure you're in a good state of mind and not currently filled with negative emotions such as anxiety, apathy, fear, greed, or impatience. Have a trading plan and stick to it. Always trade in a methodical manner. There's no place for random improvisation when you enter or are in the trade. To avoid revenge trading, be fully present and focused when trading. Ensure you're in a good state of mind and not have any negative emotions in you. Have a trading plan and stick to it. There is no place for random improvisation when you enter or R in a trade. If you want to succeed as a trader, you must think long term. Don't stress over one loss or even losing a couple of days in a row. Stay focused on your trading performance over the coming months and years. Think of the long term and not short-term losses. It's easy to think that the more you trade, the more money you make, but the opposite is true. Trading is a game of patience. Traders who wait for quality setups and sit on their hands in between are the ones who end up profitable in the long run. Focus on the process, not on the profits. Trading is a game of patience. Wait for a quality setup. Wait for a quality setup. Don't put a trade on, don't put a trade on, don't put a trade on. Okay. Over leveraging. In Forex trading, leverage means that with a small amount of capital in your account, you can open and control a much larger trading position. For example, with a $1,000 account, your broker might allow you to open a $100,000 position. This is 100 to 1 leverage. The advantage of using leverage is you can magnify gains with a limited amount of capital. Leverage can magnify gains using a limited amount of capital. The disadvantage of leverage is that you can also magnify your losses and quickly blow your account. However, losses can also be magnified and your account will be... However, losses can also be magnified. Why is my account balance negative? When trading with excess leverage, a small price swing can wipe out your entire account balance. The greater the leverage levels you use, the greater the swings in your account equity. In most cases, you'll end up with a margin call. The greater the leverage used, the greater the swings in your account equity. When your account equity is jumping around due to your highly levered positions, good luck keeping your emotions in check and not letting it affect your thinking. Nobody will want to be around you when this is happening. I'm mad at you because the value of my trading account is so volatile. When trading with low or no leverage, you will give your trade room to breathe and protect your trading capital. For example, you'll be able to accommodate wider stop losses while keeping your risk limited. The higher your leverage, the greater your risk on each trade, likely resulting in irrational decision making. Low leverage gives more room to breathe and is able to accommodate wider stop losses. The higher the leverage, the greater your risk is, which results in irrational decision making. Knowing the link between leverage and your account equity is crucial since it determines your true leverage. Here's a study that was done by a popular Forex trader broker showing the percentage of profitable traders by average true leverage. Less than 5 to 1 winning percentage. So the less leverage you're using, the more winning percentages you are, or the more trades you're winning basically. Those that are above 25 to 1 only 17% of them is winning. Leverage. As you can see, profitability declines substantially as true leverage increases. Profitability decreases substantially as true leverage increases. 40% of traders using true leverages of 5 to 1 or lower were profitable, compared to only 17% of traders using 25 to 1 leverage or higher. Most professional traders trade with very low leverage and rarely go above 10 to 1. That's how they stay in the game. Regardless of the leverage amount that your broker offers, you can emulate these lower leverages by simply depositing more money into your account and managing your risk properly by using proper position sizing. Use a true leverage of 10 to 1 or lower. Only risk 10% or less of your account balance at any given time. Never let the value of all your trades open exceed 10 times your account equity. I realise that my blood pressure stays low even when I keep my leverage low. Only risk 10% of or less of your account at any given time. To calculate a true leverage of a single trade, divide your trade size by your account equity. I think we've got some of this fallen before, so true leverage is equal to trade size divided by account equity, like that. For example, if you open an account with $5,000 in equity, a 10 to 1 leverage would mean opening positions no larger than 50,000 or 5 mini or 50 micro lots at a time. The lower leverage, the safer. For example, a 2 to 1 leverage would mean opening positions no larger than 10,000 or 10 micro lots at a time. If you care about longevity as a trader, the less leverage you use, the better. Having access to high leverage doesn't mean you need to use it. I shouldn't have used so much leverage, now we're homeless. When you first open your live account, try to start trading with zero leverage. For example, you have $5,000 in your trading account, don't open your positions larger than 5,000 at a time. With experience, you learn when it's best to use leverage and how much leverage to apply to help you achieve your financial goals. When using any amount of leverage, trading with caution should be your priority. Excess leverage makes profitability significantly less likely. When opening your first live account, start with zero leverage. Excessive leverage makes profitability significantly less likely. Okay, what exactly is leverage and how does it work? Learn more about leverage before you blow your accounts. Overexposure. When you have multiple positions open in your trading account and each position consists of different currency pair, always make sure you're aware of your risk exposure. Both of my trades got stopped out at the same time. For example, on most occasions, trading AUD-USD and NZD-USD is essentially like having two identical trades open, because they usually move in a similar manner. Even if there are two valid trade setups in both pairs, you may not want to take both. Instead, it might make more sense to take one out of the two setups. You might believe that you're spreading or diversifying your risk by trading different pairs, but many pairs tend to move in the same direction. So instead of reducing risk, you are magnifying your risk. Unknowingly, you're actually exposing yourself to more risk. So this is just the currency correlations. So currency correlations. This is known as overexposure. when trading two currency pairs which move in the same direction but instead of reducing your risk, you're increasing it instead. Unless you plan on trading just one pair at a time, it's crucial that you understand how different currency pairs move in relation to each other. Know how currency pairs are in relation to each other. You need to understand the concept of currency correlation. Currency correlation measures how two currency pairs move in the same, opposite, or totally random direction over some period of time. You need to be familiar with how currency correlations can affect the amount of risk you're exposing your trading account to. If you don't know what the heck you're doing when trading multiple pairs simultaneously in your trading account, don't be surprised if your trading account balance goes poof. Are you doubling or tripling your risk without knowing it? Learn more about currency correlation. We just came from doing that, so yep, all good. Overriding stops. Stops losses are pending orders you enter that effectively close out your trading positions when losses hit a predetermined price. Stop losses are orders, pending orders, you enter that effectively close out your trading positions when losses hit a predetermined price. It might be psychologically difficult for you to acknowledge being wrong, but swallowing your pride can keep you in the game longer. Do you have the mental toughness and self-control to stick to your stops? My stop loss is about to get hit. I set it too tight. Price is just about to reverse soon. I'll just remove it. In the heat of battle, what often separates the long-term winners from the losers is whether or not they can objectively follow their predetermined plans. Traders, especially the more inexperienced ones, often question themselves and lose that objectivity when the pain of losing kicks in. Negative thoughts appear such as I'm already down a lot, might as well hold on, maybe the market will turn right there. Wrong. If the market has reached a stop, your reason for your trade is no longer valid and it's time to close out. If the market has reached your stop, your reason for the trade is no longer valid and it's time to close out. Do not widen your stop. Do not widen your stop. Even worse, do not override or remove your stop and let it ride. Do not widen, override, or remove your stop. This is where I removed my stop loss and it blew my account. Increasing your stop only increases your risk and amount you will lose. Increasing your stop increases your risk and the amount you'll lose. If the market hits your planned stop, then your trade is done. Take the hit and move on to the next opportunity. Widening your stop is basically like not having a stop at all and doesn't make any sense to do it. Widening your stop is basically like having no stop at all, and there's no sense in doing it. Stop losses help you limit your losses and help you move on. Learn more about the different types of stops, losses, and how to properly use them. The 5 O's of trading: how traders destroy their own accounts: overconfidence, overtrading, overleveraging, overexposure, and overriding stop losses. Cool. Yeah, okay. I'm gonna leave this episode here then. So in the next episode, we're gonna carry on with the most common trading mistakes new traders make, with how to lose all the money in your trading account in 10 days or less. So, which trading style, quiz, graduation speech? US regulatory agencies. Okay, yeah, so thank you all for watching, and I will see you guys in the next video. Goodbye!